Welcome to the Finance Storyteller series. This video covers 7 tips for stock market investing. Actions speak louder than words. I'm going to show you what I strongly believe in, which is the same as what I have actually invested in. After all, if you think you have great ideas, show that you're serious about them by putting your own money at risk. That's called skin in the game. Tip number 1. Avoid the risk of ruin. The existentialist philosopher Jean-Paul Sartre said, "Existence precedes essence," which in the context of stock market investing means make sure you don't go bankrupt, otherwise there will be no portfolio to pick. Here are some key actions to take care of right now. Pay down credit card debt. Simplify your life by limiting the number of credit cards you have and be aware of their high cost. If you annualize the interest rates you pay, you will find out it's an expensive form of financing. Pay down part of or all of your mortgage debt. It's great to own a home. Maybe even a home with a garden and some flowers and butterflies. It feels even better when it's all yours without a big loan from the bank looming over you. That makes you sleep a lot better at night, in case you would ever lose your job. Or, if you are an entrepreneur, in case your order book dries up. Pay your taxes on time. Don't get in trouble with the government. It is a waste of everybody's time and resources. And besides, the salaries of your local school teachers and fire brigade need to be paid from the tax revenue that you cough up. Beware of the bull trap. In the days of irrational exuberance, financial products were sold with advertising campaigns promising triple profit. Financial advisors failed to explain what was really happening, investing in a limited number of shares with money borrowed at high interest rates. When the stocks subsequently dropped significantly in value, investors were left with triple losses rather than triple profits. What did we learn from the financial crisis? Leveraging can be toxic. Don't borrow money to invest. Don't invest in things with cryptic acronyms that you don't understand. They might blow up in your face. Does anything in this structure sound like Japanese to you? A key thing to remember, if it sounds too good to be true, it probably is. Now that we have covered the risk management and the things you shouldn't be doing, let's turn to what you could or should be doing in building your investment portfolio. Tip number 2. Invest in what you care about. When I deliver Finance for Non-Financial Managers training at my clients, I notice I am more passionate and engaged when the success of their company and my personal financial success are aligned. 1/3 of my stock market investment portfolio is in shares of customers. I hope they will do well for their sake and mine. And for the record, no, I was not in possession of material non-public information when making these investments. If you are an employee of a publicly listed company, you could invest some of your money in shares of your company. Be careful not to invest too much though. You don't want to get into a situation when you're suddenly out of a job after a big restructuring because the company isn't doing well and your shares are dropping at the same time. You could also invest in causes or industries you care about. Are you fascinated by clean energy or technology gadgets? This is your chance to morally and financially support them by buying the stocks. Tip number 3. Be humble and try to learn from your mistakes. Chances of outsmarting the market are minimal. Investors tend to overestimate their own skills and abilities and underestimate the influence of randomness. Morningstar is a research agency that reviews performance of investment funds. They publish overviews on a regular basis that is often very humbling. The percentage of outperforming funds is very low, only about 25%, which is worse than a random coin toss. You could even argue that having a monkey selecting stocks for you by throwing darts at a newspaper has the same or better odds of success as active investment management by a highly paid fund manager. My personal experience is that I was once defeated by a toy giraffe in a stock market investment contest. Since then, I have put my money more and more into ETFs, exchange traded funds or trackers. These trackers just passively follow an index and charge fairly low management fees. Currently 45% of my investment portfolio is spread over 6 ETFs. Hindsight bias, overconfidence, black swans and the turkey problem. Are these terms that are familiar to you? If not, then you should read the Holy Trinity of modern psychology and philosophy, Kahneman's Thinking Fast and Slow and Taleb's The Black Swan and Anti-Fragile. A key learning from these books: don't look for causality when there isn't any. Instead, use a lot of trial and error. Tip number 4. Minimize transaction cost. A bit of commission for your broker on each buying and selling transaction does not sound like a big deal, but if you make many trades, it does add up to a material amount, and transaction cost could start to eat up a significant part of your returns. My strategy on this one is to go for buy and hold, making only infrequent trades. Tip number 5. Don't expect your stock portfolio to make you happy. Joseph de la Vega wrote one of the very first books on stock market investing, published in 1688. Joseph was a Jewish exile living in the Republic of the Netherlands during the Golden Age, just like the great philosopher Spinoza. Joseph de la Vega describes how investors suffer emotionally. If you buy stocks and they go down in value, you'll be unhappy you bought them. If you buy stocks and they go up, you wish you had bought more. If you sell stocks at a nice profit, but the stocks keep going up, you regret selling them too early. If you don't buy a stock and it goes up, you regret not buying them. If you hold on to stocks that go down, you wish you had sold them earlier. In short, having an investment portfolio can be an emotional roller coaster. Come to think of it, maybe you shouldn't buy stocks at all, but rather spend the money going on a nice holiday and enjoy watching the sunset. Or buy some nice artwork to put on your living room wall. Priceless. Tip number 6. Understand the strategy of the companies you invest in. What is the unique and sustainable competitive advantage they are trying to build? Furthermore, what is the optionality of the companies you invest in? Are there any indicators that the stock is ready for takeoff? Is the company a potential takeover target? Will they suddenly announce a big increase in the dividend they pay? Will they split up their conglomerate structure into individual divisions? Tip number 7. Make sense of a company's numbers. Familiarize yourself with terms like assets, revenue, EBIT, EBITDA and free cash flow. The Finance Storyteller series can help you understand these. Be aware that a great historical financial performance is no guarantee for future success. There you have it. 7 clever and reliable stock market investing tips. Avoid the risk of ruin. Invest in what you care about. Be humble and try to learn from your mistakes. Minimize transaction cost. Don't expect your stock portfolio to make you happy. Understand the strategy and the optionality of the companies you invest in, and make sense of a company's numbers. I hope this was helpful. Thank you for watching. Please subscribe to my YouTube channel. More videos coming soon.